Hello everyone, Jeff Green again here with another market timing market analysis update in preparation for trading week, fiscal week 17 starting on April 25th, 2022. So please like and subscribe if these videos are useful. That would help me a lot. Appreciate that. So what we're looking at here is the usual VTI chart, weekly chart on the left, daily chart on the right. And we're going to talk about market action this week and what we can reasonably expect in the next 2 to 4 weeks. And then we're going to take a look at interest rates. I think a quick overview of the panic that ensued Thursday and Friday of the prior week might be a little bit insightful to look at a couple of charts to see how the interest rates really might affect the economy. So let's take a look at the chart here for VTI, and let's sort of focus mostly on the daily chart. What I did here is I put a couple of blocks because many people have been asking me how do you read these sorts of charts. So I put a green box here around the parameters that I look at to tell me whether I should be buying stocks, and then I put a box around here in this time period where you might have taken some positions off the market or at least tightened up on profit. Let's call them profit keeper stops is what I like to call them, because you want to take profits at the top as best you can and then sort of re-entry into the bottom. So let's take a look at the start of this green box here. I'm going to see if I can draw a straight line right down to the bottom, and usually I do this without looking at the price charts when I'm trying to figure out what I'm trying to do here. But let me just draw this line down to the bottom here, and let's just sort of go through the chart. So up until this start of this green box here, we had a pretty strong downtrend, as we talked about in several videos. At the start of this green box, we had a 3x8 moving average cross, which is positive. We had some volume days above average, but not a lot, so I was a little bit cautious. The big thing here was that even though the MACD was below zero, it started moving up on some pretty strong momentum. The unbalanced volume line, the signal line not only crossed, but it moved up above this green longer-term moving average. We had an increase in the advanced decline on the New York Stock Exchange, and at least not a decrease on the NASDAQ advanced decline line, and that was above the longer-term moving average also. And we had what appeared to be a cross going here on the ADX. So all in all, that looked like a pretty positive time to start taking on positions, and as you can see, that was a good time. If you look at the movement from where we started here at the beginning of this green box to up in here when we sort of decided to get out, that's a pretty strong move, and a lot of profits to be made there. So let me erase all these lines, and then I'll go through this sort of transition zone here. And I'm going to draw the same line right down as straight as I can. Don't test me on this because sometimes I cannot draw the straightest line, but I think you get the idea here. So a transition from a bullish sort of market period to a bearish market period. We see the MACD crossing. We see the unbalanced volume crossing. Even though it's not below the long-term average, you do see a negative signal there. You see that already the the advanced decline on the New York Stock Exchange is dropping. It's reached a new low, and it's below the average. And of course, the NASDAQ, which has been really horrible on advanced decline line, was well ahead of the New York Stock Exchange on the drop from the advanced decline line. We also had the DMI minus above the DMI plus, which is sort of you count them, there's any number of bearish signals here. So starting, in this time period, when was that? Sort of beginning part of April, would have been time to start taking profits off and sort of slowing down your buying. 3x8 cross, I don't know if I mentioned that or not, but the 3x8 cross prices were pushed down by the 200-day average and are still below the 200-day average. So let me get rid of these lines and let's sort of talk about where we are today. So last week we talked about support at this area here, and if we close down below this support, that's going to indicate some trouble. So let's take a look at the same series of indicators that are right here and sort of see where we go from here. So what can we reasonably expect? There's a pretty strong level of support right in here. These lines go back some time, so we might get some support at this level. We might get a bounce here maybe, or a bounce here maybe. I think a bounce is likely. Whether or not it will produce a new uptrend is anybody's guess. But you can see that this downtrending line across the highs here is going to be a challenge to get across. So I think we've got maybe some bounces in front of us. I don't suspect it's going to crash right through these lines, but again, no one ever really knows until it happens. But what's negative about this vertical line here? First of all, we've got increased volume on a down day and a significant down day. So that's strengthens the move downwards. We've got MACD below zero and a MACD momentum showing increasing momentum to the downside. We've got the on-balance volume looking rather bearish. We've got the advanced decline line on the New York Stock Exchange in a downtrend. We've got the advanced decline line on the NASDAQ on a downtrend. And we've got the DMI minus above the DMI plus. So you count them. In my book, they're all negative. So I think this week is going to be a risky week. I think prudent traders should take profits where they still have them. Adjust stop losses if you think you're going to get into a losing position, and sort of wait it out. And I would strongly recommend you take a look at contra ETFs for new positions, especially if prices close below this line here. If we close below this line here, then you're looking at, if you look back over the weekly charts, you've got no support that I'm showing on this graph. Let's see if I can get a support line up here. So got really no support until we get down here, which is a significant drop. So I think you need to be careful this week. I think you need to step aside and let the negativity work its way out. So having said that, I think it might be interesting to look at, let me erase all these, get my pen back, close this guy out. Let's look at interest rates here, because this is insightful. Everybody's scared to death of interest rates, and in my personal opinion, interest rates have been too low for way too long. We've had this level down here, and if you look at this, this is a 0% interest line, which means that you don't get much money for lending your money out, especially to the bank. It makes banks' profitability challenging at best. And you can see just by eyeballing this chart, this goes back to 1960 to this year, and you can see this little blip here, right here, which is the most recent interest rate increases. So they've been in a downtrend for, gosh, let's count them up, since 1980. What is that, 40 years? And I'm an old guy. I'm sure many people that I'm talking to here started investing in the raging bull market of this area, where interest rates were just going through the floor. That's not normal. You can see just by eyeballing this chart that about an average interest rate seems to be sort of right in here. Somewhere between 6 to 8% is a normal interest rate. We haven't had that for, gosh, a long time, at least 20, 25 years perhaps. So that's caused an enormous disconnect between stock prices and reality, quite frankly. This period in here, I remember this period quite well. Like I said, I'm an old guy. I remember when I was fresh out of college, interest rates in the money market was at 18 to 19%. And you could have bought long-term bonds at an extremely favorable interest rate. This was inflationary times and a troublesome market time, but we made it through. And I imagine that this time we'll make it through also. So let's not be too worried about interest rates. I think they can get back up to this area without causing too much trouble. There certainly will be dislocations and changes in stock price strategies and that sort of thing, but they've been low for way too long. Let's take a look at, let me move this chart. I want to talk a little bit about the interest rate inversion, which has brought about a resurgence of the R word, the recession word. So here's a chart of interest rate inversions that go back to 1965. And let's just talk about this for a little bit. The argument is that when interest rates invert, that's the red areas on the chart here, that means that long-term interest rates are higher than short-term interest rates. And the argument is that that has the effect of freezing out long-term development for short-term business advancement activities. And the claim is that as soon as you see one of these inversions then what follows is the inevitable recession. So this is where we are on the inversion chart right now. You can see that we had an inversion that was caused by the interest rate adjustments the Fed did to let's say cure, quote unquote, the COVID panic, which you can see that this very thin gray line here, this was claimed to be a recession. Personally, I disagree with that because that was a purposely caused pullback on business activity caused by telling everybody to stay home from work, put masks on, don't talk to your neighbor, don't go to school, don't go to the food store, and that sort of thing. So it remains to be seen if this inversion caused the COVID recession or if we have another recession in front of us. You can see that they're all pretty close in time to the inversion event and the quote-unquote recession. So I think the story here is I don't see any reason to panic per se. I think that you'd be smart to sort of step aside from the market, maybe take some short positions or contra ETFs. You can check my stock list for this week for a list of quite high volume contra ETFs, and sort of play the week. Stand aside if you're a prudent trader or a longer term swing trader, and aggressive traders and play to the short side. So I hope that helps. Please like and subscribe, and I will talk to you next week. Thank you.